All right. Okay, so good morning, good afternoon, and good evening to everyone. I hope your families and you are safe and well. Welcome to the webinar on trade, investment, and investing in the UN Sustainable Development Goals, hosted by Global Policy Insights. Let's perhaps give another 30 to 60 seconds for more attendees to join in. Until then, I'd request everybody online to keep themselves on mute until they're about to proceed to the discussion. All right. Well, once again, welcome to the webinar on trade, investment, and investing in the UN SDGs, exploring barriers and opportunities in 2020, hosted by Global Policy Insights. Well, as you all may be aware, the UN Sustainable Development Goals, also known as the Global Goals, were adopted by all UN nation member states in 2015, universal call to action and authority to protect the planet and ensure that all people enjoy peace and prosperity by 2030. I'm Jasmine Mehta, and I'm a non-resident fellow at Global Policy Insights and will be a moderator for this panel session today. As for the format of today's webinar, I shall pose a question to each panelist to really kickstart our conversation, and that would cover for about 40 minutes, after which we shall proceed to respond to audience questions. As a mandatory housekeeping plugin, I would request all our attendees to keep their lines on mute. Also, please use the Q&A box on the right side of your Zoom screen to ask questions. With this, I'm honored to present to you a very distinguished panel today. We have Mr. Joseph Cox, who's the Assistant Secretary General for Trade and Economic Integration at the Caribbean Community, also CARICOM. Mr. Cox has been an applied economics consultant and advocate for over 25 years. Prior to this, he was managing partner for the Center for Growth and Development in Jamaica, and doubled as the Executive Director, Growth Secretariat at the Planning Institute of Jamaica, and provided oversight for Inter-American Development Bank and the government of Jamaica. We have with us Mr. John Dickson, who is the former chairman of the World Trade Centers Association Committee on Peace and Trade. John's career combines extensive experience in international intercultural program development, interpersonal communication, and organization business. Currently, Mr. Dickson serves as a senior advisor to the Latin American Presidential Mission, which is an association of former heads of state from Latin America who are committed to good governance, sustainable, and economic development. We also have Isabella Bertani. She is the founder and chief client strategist of Bertani, a boutique audit, tax, and advisory firm in Toronto, Canada. With over 25 years of experience, Ms. Bertani has worked extensively with both private and public companies in various industry sectors. Her practice focuses on inbound foreign direct investment and Canadian domestic companies with global interests. Moving on, we also have Arpit Chaturvedi, who's the CEO of Global Policy Insights and co-founder of Invico. Global Policy Insights is an Indian-centrist policy think tank with strong connections to UK and Washington, DC. Arpit also serves as a senior expert editor on the international political economy and governance for defense and intelligence in Norway. He served as a lecturer on public administration at San Francisco State University and the Indian School of Public Policy. Finally, we have Jonathan Cummings, who's a steering member of the Alliance of NGOs and CSOs for South-South cooperation. Jonathan has had significant professional experience working on the political campaigns, international NGOs, and operating within the United Nations space. Currently, Jonathan has been, very closely associated with GPI as also an advisory partner. So thank you to all our panelists for your time today. To really commence our dialogue, I'd like to leverage a use case here to advance the practicality in the topic. For starters, I would like to ask Mr. Cox. CARICOM is really an organization of 15 countries throughout the Caribbean with objectives of promoting economic integration and also to coordinate foreign policy. Now, in terms of trade and investment, Mr. Cox, would you be able to speak a little more about CARICOM's role in that area and also the importance of public and private partnership in the Caribbean community?
Okay, all right. I will attempt to engage in this part of the dialogue by saying that one of the things that we have to recognize is that CARICOM is basically a particular regional construct that is founded upon intergovernmental consensus. Now, in so doing, one of the things that we recognize is that trade and investment is probably one of the, well, it is an important linchpin that holds the community together. As we look at a dynamic whereby you have countries at varying stages of development, and therefore you have their own, each one comes with its own unique challenges, and therefore you have to seek to nuance policy and policy delivery along a particular continuum so that you can optimize your outputs. Now, that is how, I'm saying that to say that when you are looking at what comes out of CARICOM and its role in trade and investment, is that we're looking at a scenario whereby, by way of the regional construct, you have free movement of goods, services, labor, etc. And the point and where we're going with all of this is that we therefore have to provide the regional policy oversight, as it were, whereby coming out of that, you allow for the movement of goods and services within the region, within a particular construct. Now, that being said, when we have to do it in partnership with a number of our associate institutions. So what, for example, we would have in that particular scenario, we would have the CAFSA, the Caribbean with the association which treats with SPS issues, sanitary and phytosanitary issues. We have CrossQ, which deals with issues of standards. We have the CCRE will deal with issues of energy, etc., etc. So what, in other words, what we have is a scenario where in totality, we are dealing with a number of issues, but really seeking to optimize the policy dynamic within which the countries operate. Now, when we speak about the issues of free movement of goods and services, to underpin that regime, we have a rules of origin mechanism as well as a common external tariff. Now, it might interest you and the audience here that even though we are in the midst of a COVID pandemic throughout the region, the fact of life between January and end of June, we are looking at upwards of 500 million US in suspensions of the common external tariff, which allows for people to bring in goods which are not produced in the region, but which are critical to basically processes of life, of livelihoods. So we talk about intermediate goods, certain consumer items that are not produced. We have particular issues with the sourcing of PPEs. I think, in fact, truthfully, we still have some issues surrounding that. So the point is simply this, but what that figure does represent is, if you use it as 500 million, we have 500 million opportunities for our private sector to step up and engage. That is what this is about, because the CET and the protective tariff regime is really a mechanism which is to protect your fledgling industries, but which will create, which hopefully will create a kind of market dynamic where the private sector will step in and fill the void and therefore expand the region. The treaty, the 240 articles of the revised Treaty of Chaguaramas, which is basically our Bible, as I would say. One of the things that it also emphasizes is the issue of production integration, because it recognizes that you have situations whereby because countries may be constrained by size and other individual challenges, you find that you can end up with a lot of cross-border dynamics that you would not normally have to look at in that sort of scenario. So one of the things that we have done through the CARICOM construct is that we have, for example, the cross-border movement of your agricultural extension officers, where we can get into, creating that platform whereby people can avail themselves of various pieces of information and learn from other experiences that are obtained in other countries. So you don't have to keep reinventing the wheel over and over. But what I'm saying that to point out is that what we do is, aside from the policy development role, we also get involved in the scenario whereby we're creating a dynamic for the cross-border fertilization of ideas, and basically you're learning from each other as you move, as you go along. So you don't keep going over and over, because one of the challenges that the region has, as I transition into your second part of your question about the PPPs, is that most of the countries, frankly speaking, they have very high debt to GDP ratios. Most of them are in excess of 100% of GDP, and therefore they have limited fiscal space. Now, another part of the challenge that we face in the region is that, of course, we are extraordinarily vulnerable to the ravages of climate change. And indeed, for some countries, it is actually an existential crisis. Now, what has happened is that we have very high rates of investment, but I would say to you that the high rates, the data, while showing high rates of investment, one of the things that we have to recognize is that the high rates of investment are also reflective of high rates of replacement investment, right? Because, for example, if you have situations whereby through a hurricane in a matter of 3-4 hours, you're talking about damage of 100, 200% of GDP, obviously you have to rebuild your bridges, your roads, and your basic infrastructure framework. Now that is where your PPPs come in, and that's why I was particularly excited when this aspect of it was added to the program, because the truth be spoken is that, constrained as we are regionally in terms of the debt and the absence of fiscal space, the PPP framework is perhaps the only mechanism we can have whereby you can incorporate your private sector to build out some of your necessary infrastructure, be it roads, bridges, schools, etc. And therefore take the constraint of the state in terms of the allocation of resources. I mean, yes, it does have its own elements of controversy, because some people are quite wary of having things like toll roads and other cost recovery mechanisms, which do come with PPP frameworks. But the fact of life is that for us to move forward, we have to embrace that particular concept, and we are actually engaged in that. There are countries in the region who actively engage in that sort of thing. But then, and the other aspect of it that we also are pushing is that, and in fact, were it not for COVID, we would have probably by now have had approved our credit reporting policy and our deposit insurance policy and the capital markets policy. And the reason why I raise particularly are the securities policies. Why I'm raising that in particular is that a lot of the countries using the capital markets can also be an excellent mechanism for them to divest themselves of a lot of the entities that governments have gotten themselves involved in over time, that are really and truthfully, physically, philosophically, and practically really should not be involved in. And it's an excellent mechanism for them to divest themselves of these things by and also bolstering the use of the capital markets in the country. And in that respect, I refer, like, for example, what is happening in Jamaica, where you notice that that particular strategy is being used to divest a lot of the or some of the government entities. You have the toll road network, that is one of them. They had an energy facility that was equally they use that modality to treat with it. So the bottom line of what I'm saying is that aside from treating with the issues of the policies, of course, the overall framework in which we operate, be it regarding movement of labor, access of resources, movement of capital, etc. We are also, from the other standpoint, seeking to advance and look at how is it we can truly transform, engage in the transformative aspects of this region, particularly in the post-COVID environment, taking into consideration that we also have to look at matters looking at such as what is the demographic makeup of your region. Because, for example, as we look at implementing what we could consider transformative policies, the reality of life is that if you're looking at what we would call the baby boomers age group, which I cheerfully identify with, we may be a little bit more reticent, a little less involved in the technology versus, say, a Generation Z, who are you, was 5 to 25-year-olds, who are all in their entire policy framework is and whole orientation is driven by technology. In other words, we have to ensure that as we move forward, we nuance the policy delivery in such a way that we accommodate that sort of thinking, that whereby we might be, some of us over time might be awed by some of the technological developments. We might be flattered by the notion that we now have telemedicine developing in the region. The fact of life is, for the Generation Z, they assume that to be baseline developments. And therefore, so in other words, when you're looking at the transformation, when you're looking at the involvement of trade and investment, and how you nuance that investment, how you create that ecosystem within which you want the businesses to be operational, you have to take into consideration all of these dynamics: technological transformation, policies, etc., etc. I think I will yield at this point, Madam Chair, with your permission. Thank you very much.
Thank you very much, Mr. Cox. This is extremely helpful in, of course, setting the landscape for our continual discussion, and also, your two particular points around, the PPP being one of the best options when your fiscal spread for a country is low, and also leveraging capital markets for sort of raising capital, of course, for aligning to UN SDGs. So thank you very much. I think pretty much moving on from your John, if you'd like to weigh in, you've extensively worked with World Trade Centers Association, and you've personally worked with, developing trade centers in various countries. Could you shed some color on what is the purpose of, trade centers? How can developing these apply to UN SDGs and cumulatively solve for the world's development challenge?
John, I think you're on mute.
I'm an example of what Joseph was talking about, of the challenge of technology for boomers. I'm really inspired by your comments and very happy that the Caribbean is in good hands. I think the framework you kind of laid out shows a deep respect for the private sector, and looking at the private sector in the PPP, the second P is very, very important, I think. That's where the juice is, and that's where the prosperity, of course, comes from, and development. So I'm and governments can't lift people out of poverty. That's just a fact. So, but they need to create the framework that allows the private sector to flourish. So, and I think that what you laid out there was very helpful. I came into this World Trade Center space totally by accident. I was a vice president of the American University Extension in Okinawa, Japan, and I started feeling guilty because we were giving international training to students, but there were no jobs for them in Okinawa after they were trained. So I was breaking up families and feeling bad about that. It turns out Okinawa was for centuries an independent kingdom that depended a lot on trade. So I thought, I had a good friend that had started the World Trade Center in Portland, Oregon, and I thought this project might be able to bring back the heritage of the people of Okinawa. That was my motivation. And I had no idea about trade, investment, anything like that. My background's architecture and human relations. And so I found that project to be extremely important and powerful, and bringing that awareness back to the people that had really lost it. They had been annexed by Tokyo and really had lost a lot of confidence and a lot of their international connections, which was kind of ironic. So the World Trade Center Association started in 1970, founded by the guy who built the Twin Towers. That was the headquarters, and now there are more than 320, I think, in about 95 countries. And what the trade centers do is basically empower the SMEs, the small medium enterprises. Big corporations don't need a trade center to navigate the global trade or get access to the market. So it's a very powerful tool, and I think the SMEs are what builds a sustainable and healthy economy. So they're a great tool, and only a tool, though. They don't create any magic at all. And it's the most poorly branded, probably, organization on earth. When you say World Trade Center, people think of the Twin Towers, and that's all. And they're all, the Ronald Reagan building in Washington, D.C. is a World Trade Center, and nobody knows that even in Washington, D.C., unfortunately. But it is a very helpful tool. And I'm hoping, Joseph, that it is established soon, as soon as the chairman of DDL gets back to Guyana, we can move that project along, because that'll help not just Guyana, but I think the whole Caribbean through the CARICOM presence there. So for me, I'm very, I think the SDG 16 is the piece. So while I was in Okinawa, the Twin Towers got hit, and I was teaching a seminar at that time to the military officers, Japanese military officers, very intense. I walked in the next morning. It happened at night there. In the morning, the two big monitors showing the Twin Towers. That was our headquarters. I didn't know, I couldn't call, couldn't email, no way to know what's happened there. And they come up to me, how are you going to retaliate? What's America going to do? And I could just have to go out in the hallway and cry, because I really didn't know. I had to wait the whole week to finish the seminar and to get a flight into New York. And luckily, I did lose some friends there, but I thought so hard about this, how to retaliate, and realized that we should build a World Trade Center in Afghanistan, that would be the best way to retaliate, because I thought what makes a country dangerous is isolation. And so, and through that project and pushing the association on that, that's when we started this committee on peace through trade, and I became very familiar with that, and the power of trade and business in building peace. And I'm glad to be in Arpit's living room right now, because I use always the example of India. 2001, 2002, it was in the newspapers every day in the United States that there was going to be a nuclear war between India and Pakistan. And then suddenly it left, there wasn't a story, the story disappeared, but there was no explanation. Jimmy Carter didn't go there, the blue helmets of the UN didn't go there. There was no story. What happened? Just it suddenly disappeared. A nuclear standoff disappeared. And honestly, no big deal about it. But then what happened was in India, my understanding, the private sector approached the government and said, you know, they started getting calls. There were so many back offices in India that if you, by the way, we're looking, just want you to know, we're looking for another we're looking at other Philippines and other places to put our office. Because if, you know, you're going to have nuclear war, you know, we got to be, we can't miss our, you know, we have to have consistent supply. So the private sector just said, no way, stop. Even if we don't have a single casualty in India, we've lost our economy for 30 years because those companies won't come back once they relocate. So that's, to me, a great example of the power of business and in peace building. And you don't often hear those stories because they're not in the newspaper, because you don't see the war that was averted because people were trading, because they were. But once a businessman is invested in another country, he wants those people to be healthy, prosperous, and happy. That's all he thinks about. Any kind of bomb going off or any pet, you know, any disease, any problem there is gonna not just hurt his bottom line, but it's gonna. He's built his business through trust, and he knows the people there, and it's heartbreaking. So this is a sustainable way to accomplish SDG 16, because it's not by government decree, and it's also the private sector is self-sufficient, and it doesn't require government funds or donations. So it's not dependent on policy, but it is sustainable. And this is where I think I like the word in the SDG, the S, because my interpretation of S is that which generates revenue. Anything else, when the donations stop or the program is over, the government program, then it stops. But sustainable is what generates revenue. Now, there's of course many definitions of sustainable out there, and so I found this to be a universal principle and thrilling, and I just pushed it all over the world. I've been just recently in Guyana, so excited about Guyana, and making a World Trade Center. We just finished an application for Ramadi, Iraq, because I really think it helps everywhere. But, you know, Thomas Friedman had written a book, The World is Flat, said no two countries both had a McDonald's ever went to war. And I think that might still hold, but it probably won't for long. I think the big problem now, the challenge for me and for this whole vision is honestly the rise of China, which is a mercantilist system that really doesn't, it kind of breaks this wonderful foundation that I've believed in all this time, and it's a challenge, and it's a very a difficult one. And I'm not just saying that because I'm American. I've been to China a lot. I was in first time 1982 in Beijing when there were only bicycles in Beijing. I've been many times, and I was the chairman of the China Society in Washington, D.C. for about 8 years, which was we created to help mutual understanding between China and the United States. But the problem is the Communist Party of China, I'm sorry I have to say, which is not a Chinese, it's not an indigenous thing. And I think we need to free China, and because the people there are certainly capable and able and wonderful and hardworking, and they can contribute a lot to global peace and prosperity, you know, across the board. But the system right now is one that works counter to that. So, but again, and last point, I'm just really happy that to be here with ARPID, because I think India is more important than ever as the largest democracy and free market, I think, in the world. I think India has a very important role to play at this time more than ever. And PPP is the way to go, and partnerships, these partnerships, even on this, my screen here, this Zoom partnership is the way we build this sustainable mutual prosperity globally. The more this happens, the better. That more we understand, work together, collaborate, the better it'll be. Trade centers, I still think, are a great tool, although, the World Trade Center works best with a nice facility, an office building, an office tower with conference facilities and things like that. Now, you don't need an office tower, you don't need conference facilities, and the technology is where the trade it doesn't need a container ship anymore. It's over the internet like this. The products now have changed so much, and the whole industry is changing. So more than ever, the human relations is critical, important, and in dealing with this rapid change, and giving as many people as possible the most access, not just to technology, but to capital and to education in every way. So I'm, again, really honored to be part of this panel, and thank you.
Thank you very much, John. I think that was extremely insightful, and of course, having peace at the epicenter of sustainability in general, and thanks also for sort of shedding light on a lot of the macro aspects that do involve and impact private enterprises and their sort of response to it. I think this is, of course, a sort of a good segue to pivot, towards the investment side of the story. Starting on that front, Isabella, I do have a question for you. So, we've seen that several industries have been negatively impacted by the pandemic, right? And the economy, the global economy, has really come to a halt, and several small businesses have been shut down. So from an investment lens, how does this pandemic directly impact any type of foreign and direct investments? And also, what would be your advice for investors who are really kind of seeking to navigate through this pandemic, sort of possibly considering this as an opportunity for investments?
Thank you, Jasmine. That is a big question and a lot to cover, but I'm going to try and give some of my thoughts. So I'm really pleased to be here with my esteemed colleagues. So thank you for the invitation. COVID-19 has, certainly uprooted uprooted economic globalization, and the supply and demand have had simultaneous shocks to them. So, we are all aware that, airlines, in particular, hotels, restaurants, leisure, manufacturing, and energy, any type of industry where there has been subcomponents that have a global coordination among them, and as well any industry where there is discretionary buying certainly has been affected because of that volatility. I wanted to look at it from a few different perspectives. One of them, the production and trade perspective, the impact of that on and the pullback on foreign direct investment on developing countries, and then the reaction of developed countries to the pandemic, because it is all interrelated. So, one of the things that the pandemic has really exposed has been how globally interconnected the flow of goods and services has become. And this has, really grown, in the last 20 years. So, the United Nations Conference on Trade and Development expects that foreign direct investment is going to drop as much as 40% in 2020. I mean, those numbers are, in the early stages of the pandemic. And they're still expecting a further drop in 2021. And really because of the impact the pandemic is having on those global supply chains. I mean, even from a developed economy perspective, M&A has dropped compared to 2019 by about 53%. So the disruption in those supply chains, which is how much of the world's manufacturing production has been organized, is really caused that huge disruption. Industries like the garment industry, automotive, electronics, for example, where you have raw materials and intermediary goods that are going back and forth around the globe before they are, as they're being assembled, and then they're going to be then, shipped to another location, assembled, and then to another location where they're then developed and exported to developing and developed markets for sales. So, I had a panel discussion yesterday on the fashion garment industry, and where you have an industry where you'll have one component being done in one country, and because it is a discretionary industry, you're being hit on the supply and demand side, so you're having a shutdown on both sides. So if you look at from what's happening, and if you take China for example, and that's where we first saw this coming through, and so now they're at a point where they've gone through, I guess some people call it sort of the full cycle of the pandemic. You had the effect of containment measures that were put in place that impacted the production chains. So, and this was severe, and according to the World Economic Forum, the impact on production chains now is much more severe than it was during the SARS epidemic and during even the 2008 financial crisis. So what we're seeing hasn't been seen before. So you have a drop in imports where you've got intermediary goods being assembled in that production. This has been halted. You've got imposed restrictions on individuals where, that then results in a decrease in demand. And you've got factories closing because of the health concerns. So you start with the shock of, the initial lockdown and the impact that has in the interruption in production. And then the further shock because there's a decrease in demand from consumers, and they may be further up the supply chain in different economies. So it is definitely had kind of a shock wave across, the world. And I'm talking about it very generally. Each industry, depending on the complexity of that industry, how interrelated it has been globally, is going to have a different impact. And the ones that are discretionary, like the ones I mentioned before, are certainly from a demand side going to have a bigger impact. And if you look at it from the viewpoint of retail, for example, you'll have an industry where, the food industry definitely had a surge in sales because that's something people need. But, where it's discretionary, it's the opposite. When you look at it from an investment perspective from developing countries. So, these are the countries that need that investment. I read that the International Monetary Fund reported that there was an $83 billion in capital outflows from emerging markets. So this was very early on in the early part of the pandemic. So this is really investors pulling their money out of those economies. And that's the largest that's ever been recorded. And so on top of that, you have, a number of countries requesting emergency financing. The reason, developing countries are hit, much more severely, and I'm speaking generally, is that, they don't necessarily all have the same economic support and recovery measures in place. We saw in the early part of, when FDI started increasing, so we're talking in the late 80s, 1985, where globalization began moving supply chains and offshoring supply chains, particularly in the manufacturing sector. So you'll have, industries where they are moving components into other areas, other jurisdictions, and also in the service sector. So now we're seeing a disruption in that. Each region, depending on where their focus is going to be, impacted differently. So there's a high focus of manufacturing. Africa's focus is more in oil and gas, which is also very volatile. So the long-term consequences really depends on how quickly their economic activities can resume, and the inflows are also going to boost that. So, and remember that those inflows then affect the outflows. So if you have a component being manufactured, that's going to correlate to the exports out of that country, which then help that economy. So you also, the other thing is, because one thing about the pandemic is where you have a jurisdiction that is focused on manufacturing, the pandemic has also, I read, and again, because we were talking about the garment industry yesterday, I read that, garment manufacturers, for example, in Bangladesh are feeling pressured to restart their production, even if it's not safe, because they're worried that retailers may then move that production elsewhere to get it done faster. Whether that's the case or not, I think depends on demand, and that's also going to affect all those decisions. So it's really correlated. So it's a trade-off. It's someone, if you look at how do you mitigate this? I mean, and, one of the things that John was talking about was, trade centers. And, one of the things that we've seen is trade missions to other countries. What they do a lot of the times is match suppliers in those jurisdictions to foreign companies that may want to expand in that jurisdiction, sort of that matchmaking. And that assists those developing countries in getting that support to their local suppliers. Some of the other things like digitalization, et cetera, and creating a digital infrastructure really also depends on, what support they can have to create that infrastructure in order to allow them to operate. The thing with, the United States and Canada is that, as a developed country, they're viewed as being better equipped to weather a pandemic. They have the infrastructure in place to support the economy and put in economic recovery policies in place and support. The other impact that we're seeing, and we're seeing this, before, where we did have this movement towards protectionism and nationalism, is we are seeing now, because of the impact of the pandemic, protectionism policies being put in place. So, for example, the European Commission has, tightened guidelines around foreign direct investment to protect critical assets. So, health, medical research, biotechnology. Canada as well has put in, made some changes to its Investment Canada Act to have greater scrutiny around some industries in foreign direct investment. France as well has done the same. The US was already tightening some of its policies. So, that also, I think during the term of the pandemic is certainly going to continue. What happens in the long run, I think time will tell. You asked me about investors. I guess, every investment involves risk. The problem with the pandemic, is that you can't measure the downside of it, right? You cannot look at how do you quantify it. So how do you measure that risk? What I am seeing from my practice is I'm not seeing panic, but I am seeing people are approaching things with caution when they're making decisions. And, I think what will, in terms of industries are going to have to look at how do they restructure their global supply chains in order to continue operating in this new environment that, will continue on for some time as economies open. So that was a lot of information, and I'm not sure if any of my panelists want to weigh in as well.
I mean, I definitely feel that this is, great information. At the very least, I mean, it's quite intriguing to understand the outflow of, investments through either FPIs or also, in the capital markets that have taken place at the onset of the pandemic. But I think overall, if you look at the stock markets, they've definitely revived. Having said that, that's not the best indicator of economic progress. But I mean, from an investor standpoint, I do understand, your point around, downside. Downside risks are a little unmeasurable right now with precision. But I think the overall consensus, and to John's point, we've heard and seen a lot in terms of India potentially being the next target and a likely competitor to the Chinese supply chain. We've recently seen a lot of private partnerships taking place in India. So I think just to perhaps move the agenda ahead, I think I'd like to have Arpit kind of weigh in on the private enterprises, and I think investors were starting to look at India as an alternative investment location. I mean, Arpit, what do you think is making India an attractive investment destination? And perhaps if you could shed some light on the reforms that the Indian government is undertaking for the private sector development.
Sure. Thanks, Jasmine. I think that's an important question, and I'm going to answer it a little differently. I'm going to first answer the bit where you've asked that, why should other countries invest in India? I'm going to talk about that a little. And then I'm also going to weigh in on a little bit about what Isabella and John said. So to answer that question, that why should countries invest in India? And there are two sides to that answer. There are two parts to that answer. One is a political one and another is an economic one. And let me just get the political one out of the way first. The political answer is that I'm going to go back to the old, realist argument that when countries do trade together, and this is not even the realist part of it, because this is something which has been proven by a number of economic research and by experience, that when two countries trade with each other, both of them grow, both of them do better economically. And let's say if a country is growing economically, what is going to happen once that upward economic trend gets into place? What happens is more and more people get jobs, more and more people start consuming stuff, their lifestyle and their purchasing power, their health, nutrition, and all of these things become better. And from the government's perspective, that means that the government also is able to raise more taxes, plow it back into the economy. But also, most importantly, since I'm talking about the political side, what governments do is, especially in countries like India, a majority of their budget goes into, arming up. It goes towards defenses. And the fundamental thing from an IR perspective is, you would want to trade with a country where the economic power grows, and even if that is plowed towards defense, it is a country that has a no first attack policy, which is a policy that India follows. And it is a country where you can be rest assured that this is not going to be a belligerent nation. India, I could accept that it could be a revisionist state, but it is not a radical state. So its revisionism is sort of a soft revisionism where it seeks to reclaim its pre-colonial glory and the kind of affluence that this country had in the pre-colonial times, because just like John talked about Okinawa, I'd also like to say that India historically has been a trading nation. India, if you go back to the historical texts, you'll see people in Harappa and Mohenjo-daro trading with Mesopotamia. Then later on, the Mauryan Empire trading with Greece, and later on, Mughals trading with Europe. So India has been a trading empire all along. And what India now has decided, and I think 1991 was the decisive moment for India, where it was like our own Bretton Woods moment, where this compact was made that the question around free trade versus protectionism were settled for good. The questions were settled in a manner that we will pursue the path of free trade, as India as a nation has always. And it was decided that protectionism, and as Isabel also mentioned, that even now in the face of the pandemic, various countries are moving in the direction of protectionism, and to an extent that's all right. That's understandable, because pandemics and these shocks, they create some sort of an insecurity within countries, and there's a lot of risk involved. But the thing that all of the countries should subscribe to, and I think to a great extent they are, and hopefully they will go to that way, is that in trade, let it be some sort of protectionism now and then is all right. Let it be a boxing match and not a street fight. And that's why we need to protect some of these institutions, such as the WTO, the various World Trade Centers, and the various regimes, and the general global understanding that trade is good, and trade is something that keeps us thriving and alive as a species, and it's something which is very natural to us. I mean, even in the pre-monetary times, as a species, we were trading, we were bartering stuff. So that was the first part of my answer. The second part of my answer is that what is the government doing in India to attract foreign investments? And what any government does to attract foreign investments, or if you think from a business person's point of view, how does a business person weigh risk if they are to invest in another geography or another place where they may not know so much about, they may not have so much of influence and control. They weigh essentially broadly on three things. And the first of this is that if I'm going to set up my business, my industry over there, do we have the talent, the human resources, the intellect in that particular place, that business is going to be in good hands and it can be managed well? And my answer to that is that yes, that is true in the case of India. You'd know that 2.6% of the global IT human resource talent resides in India. 77.6% of the population is educated. Now, it is still on both these accounts lesser than China. China is 4.6% of the total IT talent, and I know 96 or something percent on overall literacy levels. But at the same time, in India, what the government is doing is that the government has come up with a new educational policy, and it is investing heavily into education. In fact, not so far back, I was part of this institution called the Indian School of Public Policy, and a classic example of how even the private sector has stepped up to invest in education, and public policy, because a lot of times, as John also mentioned, the private sector approach to government works, and the private sector approach to government is that the government does their job. It's not about replacing government with private sector. It's about a compact, an understanding between the private sector and the government that the only way to grow is to grow together, and the only way to decide on policy is to do it together and not in isolation. And I'm happy to see that in India now the private sector is stepping up in public policy, in the realm of education, health, and everything. And I see it as a direct progression from the compact that we made in 1991. The second thing that any investor sees, in addition to the human resource, talent, etc., is the political and policy environment. And over there as well, I do not know of any Indian political party, and trust me, I was born in a political family in the state of Uttar Pradesh, and I've seen that environment. I have friends in the BJP. I have family members in the Indian National Congress and friends in other regional parties, and I do not know of a single Indian political party, which says that we don't want to open up, we want to be a protectionist, autarkic sort of country. So that question has been settled long back. Now, even if you see in India, there is never a case where the capital or the foreign investments are severely damaged due to any political process. There could be, those were the things of the pre-1991 era, and I was born in 1990, and so far as I remember, I have never seen any sort of a serious threat or any sort of serious damage that has been inflicted on Indian capital, on foreign capital, on any sort of industries. And even now, if you see, a lot of people say that India needs labor reforms, and I agree that India does need labor reforms, but those labor reforms are needed not to curb the power of the labor, on the other hand, to again form a compact between labor and capital, which is also kind of been agreed upon, that the only way for labor to have a better livelihood and to be upwardly socially mobile is to have that solid compact with the capital, because if the capital grows, the labor grows. And that's, you don't have to be a mathematician to understand that. So the third thing and the last thing was the question, if you're investing in a particular country. I told you that the first one was information, the intellect, the talent. The second one is the policy and the political atmosphere of that country. And the third risk is, am I going to make money in this country? And that's a fair question. So there again, India has a unique advantage, which is that if you compare it to China or to any other country, India's domestic consumption to GDP ratio is one of the highest. It's 65% as compared to 35 or 36% in China. So if you're investing in India, manufacturing something in India, you have one of the world's largest markets right next door. Secondly, what India has, and that's an advantage and a disadvantage as well, that some of the fundamental infrastructure, such as telephone connectivity and things like those, that sort of a penetration is quite deep. It's above 90% in many areas. At the same time, there's a lot of infrastructure that still needs to be developed. And the idea being that all of that development can only happen when we understand more technology from other countries. One country brings in the technology, another brings in the capital. We provide the policy atmosphere over here. And there's a lot of money to be made in building the fundamental infrastructure of the country. And I know there are talks about creating hyperloops. There's a lot of talk about increasing the broadband capacity of the nation. Now, companies like Google and Facebook have partnered with Geo, which is an Indian organization with a mission to increase internet penetration in the country. So these are all good signs. And the third question's answer is also an affirmative that this is a country where you can get your product made for a lot less money than any other country. You can be rest assured that the human rights and the rule of law will prevail, and it will not be at the cost of exploitation of the laborers or any other section of the society. And at the same time, your capital is going to be safe. So I don't see either on the political side or the economic side as to why India does not have the right opportunity. As to what the government is doing, the government is doing all of the things that any government should do in such cases, is to incentivize by providing tax breaks, making sure that you're investing in education and health of the population, and you're opening up as you go. So I think it's on the right track, and I think the question about whether India needs to be more embedded in the global trade system has been settled 3 decades back, as old as I am. So yeah.
No, that is a very, very convincing argument, Arpit. And hopefully in the next few years, India shall definitely see, the global investment portfolio tilting and perhaps skewed in their favor. And yes, again, all the rationale that you presented are extremely, valid, and of course, very nicely complement, Joan's original point around, the India does play a very important role when you talk about SMEs, when you talk about, alignment with the SDGs, and the fact that it is a free market economy, is a democracy, and that definitely boosts the trust factor that the West would have in terms of the investments. So I think with that, I'd like to bring in Jonathan, and apologies if we're overrunning a little bit, but I think Jonathan, it'll be really helpful for us and the audience to understand, would you really kind of make the case for private enterprises to care about the UN SDGs and work towards a more positive impact lens in their investing approach?
All right, thank you, Jasmine, for that. And thank you to all the esteemed panelists here. I really appreciate hearing from everyone. And I'm the last person to speak, so I'll try to make this quick and contribute in the best way I can. So with the Sustainable Development Goals, or the SDGs, these are the universally agreed upon blueprint to achieving a better future, right? So these goals have all been agreed upon by all 193 member states of the United Nations. And there are 17 goals, and it ranges from zero poverty to quality of education, reducing inequality, peace, justice, and strong institutions, and partnerships for the goal. So when it comes to talking about investing in the UN SDGs, in my mind, I break these down into two categories of case, right? There is an emotional argument which appeals to several people who work in, civil society, NGOs, foundations, more human-centric work. And their argument is that, we need to invest in the SDGs, we need to invest in gender equity because naturally it'll make the world a better place. We want to help the world. So invest in the SDGs, invest in helping build a more sustainable future. From the business-centric argument, it focuses on economic returns. If you're a business, your first argument is, how can I get my ROI, my return on my investment? Is this good for my company? How will I get the most money? And in my opinion, the best way to advocate for investment in the SDGs is to make the case for promoting impact investment. So impact investment refers to capital investments that are made with the intention of generating measurable social or environmental impact, and naturally along with a financial return. So relating to the SDGs in which investors can, I would say, focus on, which aren't mutually exclusive, they're all connected. I would say it would be SDG 3, which is good health and well-being, SDG 7, affordable and clean energy, SDG 9, industry, innovation, infrastructure, 11, which is sustainable cities and community, and 13, which is climate action. Now, once again, these aren't mutually exclusive. I just pointed out these SDGs because in my mind, I feel like these could be concrete measures that investors invest in. And I chose these because, as I said, these SDGs relate to various sectors such as, green energy, technology, which you could make the case that is industry and innovation, infrastructure, naturally sustainable infrastructure, healthcare, ecotourism, and agriculture. So these sectors, once again, these aren't mutually exclusive sectors, but these are sectors which, in my opinion, will relate to the UN SDGs and will make a positive impact with impact investment. So now that we know this, so the thing is, how do you attract businesses and investors, right? Why should they invest in this space? So what I think it needs to happen, which this actually is already happening, is that investors are invested in impact investment spaces. Agriculture and healthcare and technology, big one, technology is a prime area for investment from investors. And these all can relate to the UN SDGs. But what I think that the UN should focus on is that it should find better ways to engage the private sector and see if there's a mechanism that the UN can set up to help facilitate impact investment and private sector engagement. Now, with engaging with the private sector, the primary purpose of the UN Global Compact is to get the private sector together. So the Global Compact was created by former Secretary General Kofi Annan. And once again, like I said, the purpose was to get the private sector engaged. So the Global Compact is the world's largest corporate sustainability initiative. And its goal was to promote sustainable development. And yes, the Global Compact is a great platform and it's led to various initiatives. But what I think is that the UN, once again, should set up a mechanism to help to facilitate private sector investment, in the impact investment space, which is mutually tied to UN SDGs. Now, quickly to close this up in the interest of time. So with that idea, imagine for a second that the United Nations created a UN Impact Investment Fund. Now, what would that look like? That would be a mechanism, an impact investment fund managed by the UNs that attract pools of capital from the private sector. Now, the UN has actually developed partnership funds with countries, with country governments, such as the India UN Development Fund, which is dedicated to invest in sustainable development projects, build waterways, clean energy infrastructure, and it has actually done some work within the Caribbean, right? This fund is actually, the India UN Development Fund is actually managed by the UN Office of South-South Cooperation. So it could be there, the case is there, and there are various examples of government funds that are already there beyond India UN Development Fund. There's also, once again, the India, Brazil, South Africa Fund, which is a fund with pools of capital from the governments, these country governments, to once again aid in development work and sustainable development initiatives. In my mind, I haven't really seen a private sector fund managed by the UN yet, right? So the way you could structure this fund, this fund could be, like I said, managed by the UN with the intention of attracting pools of capital as a mousetrap, attracting pools of capital from private sector entities and trying to encourage these pools of capital to be invested in emerging countries, in specific industries that are related to the UN SDGs, healthcare, environmental sustainability, technology, and so on and so forth. Now, I believe that this would be very good because sectors such as agriculture, sustainable agriculture, technology, and even solar energy, clean energy, these are emerging and booming industries. And as I said before earlier on, private sector, they really care about their ROI, their return on their investment. So if the UN could work with private enterprises and make the case that impact investment is the way forward, I think that'd be an excellent way to engage the private sector. And naturally, this will be wonderful for emerging economies, and it will definitely just help to make the world a better place. Thank you.
Well, thank you, Jonathan. I think that's extremely helpful in, kind of scaling up a lot of the private sector investments. And when you talk about SMEs from a UN SDG perspective, something that is done far more bilaterally right now. You look at the EU-China Green Deal, and you look at EU more generally in terms of its own domestic practices around green energy, their sustainable finance taxonomy that's coming up. So these are very, very isolated, bilateral, investments that are taking place. And of course, if it is something that is ultimately managed within the remit of the UN, it helps sort of scale this up, and also adheres to the extension of, the UNFCCC on climate change, and kind of helps kind of get to the purpose. So, thank you, Jonathan, again. And I would like to thank, all our panelists who've truly engaged in a solution-oriented discussion today on trade investments and investing in the UN SDGs. They're all working each day to move the needle towards a more sustainable and developed society. So I think on this point, I would like to thank, especially Mr. Cox, John, Isabel, Arpit, and Jonathan for your time today and your valuable insights. Also, thank you to our engaged audience for your interest. We do apologize for overrunning a little bit, but the topic and your speaker insights definitely warranted for it. So yes, and if you'd like to continue hearing from Global Policy Insights and future events, please just sign up on globalpolicyinsights.org. We shall now sign off, and we hope you have a good rest of the day and the week ahead. Please take care and stay safe. Thank you, everyone.
Thank you.
Thanks, Jasmine. Thanks, everyone.
All right.
Bye-bye. Thank you.
Thank you. Thank
Bye.
you.
Thank you, everybody.